we're going to take a deeper dive into the theory of pricing assets in the market and explore some of the ideas behind different asset pricing models. Before we do that, let's quickly recap some important insights that came with modern portfolio theory and later the capital asset pricing model, also known as CAPM. We assumed that financial asset returns are normally distributed, so their probability is determined by mean and standard deviation. When we mix them together in a portfolio, we were able to create portfolios with lower standard deviation than the individual assets. So we understood that standard deviation relates to total risk. Part of this risk can be diversified by mixing other assets with low correlation with the portfolio. We also mentioned that this diversifiable risk relates to specific company or industry risk and named it idiosyncratic risk. But there is a limit to diversification, and we can't get rid of all the volatility in a portfolio of risky assets. We called the part that cannot be diversified as systematic risk and said that it relates to the overall economy risk. The capital asset pricing model gives us a framework to price assets based on data, which, as we've seen before, relates to systematic risk. Here we have a plot with expected return on the y-axis and beta on the x-axis. The CAPM predicts that all assets should be lined up on the security tangent line here. If we ran a linear regression where the premium return of any portfolio or asset is the dependent variable and the premium on the tangency portfolio, which we define as a value-weighted portfolio of the market, is the independent variable, the results would be represented by this general equation here. If the CAPM is correct, we expect the alpha constant to be 0. So if we find assets in the market that show either positive or negative alpha, the asset would be either undervalued if alpha is positive or overvalued if alpha is negative. We could then arbitrage and extract this alpha over a time period using a long-short portfolio strategy, where we could, for example, buy the undervalued asset going long and sell or short a portfolio at the security tangent line with similar beta. This is called statistical arbitrage, which is different than a perfect arbitrage opportunity since there's still some known probability that the strategy might fail. I won't go into the details, but we can calculate this probability using the random error component of our regression here. This is a common money-making strategy used by many hedge funds. And although the odds are usually much better than playing in a casino, sometimes the strategy can go wrong, and if the bet was too big, potentially bankrupt the hedge fund. Our regression also provides other valuable information, such as the Pearson's correlation coefficient, known as the R-squared. It measures the closeness of the data to the regression line, or how well the regression explains a set of data. In our case, we can interpret it as the percentage of the portfolio or asset return, which is explained by the market return. The remaining percentage relates to other factors and is spilled over into the epsilon component of our regression, known as the random error part of our regression. Instead of percentages, we can also think in terms of absolute values of the asset's variance. And we can say that the total risk of the asset is the sum of a systematic risk calculated with the product of beta squared and the variance on the market, and an idiosyncratic part of the risk or specific company or industry risk, which is the variance of the absolute component of our regression. Many finance scholars have tried to test the CAPM using empirical data. Some of the most famous studies are the 1972 studies by Fisher Black, Michael Jensen, and Myron Scholes. And more recently, in 1992, the works of Eugene Fama and Kenneth French. What they discovered is that lower beta assets actually deliver higher returns than expected. And the opposite is true for higher beta assets. So the security tangent line is actually flatter, looking more like the red line here. The results made many question the validity of the CAPM, and this is an ongoing debate in finance. So how do we prove if the CAPM is valid? There are three hypotheses we can make. The first is stating that the market is unobservable and should include all assets in the world economy. Since we're using incomplete proxies, such as a total US equity market index, we have an improper measure of market returns. Therefore, we cannot prove that the CAPM is wrong. And it could actually be correct if we used the right proxy. Another hypothesis is saying that the market proxy is good, so there must be other risk factors that we're currently not seeing. Instead of just beta here, which reflects the overall market risk, we should have multiple independent variables in the regression and multiple betas, which would help explain the differences in expected return. This second hypothesis led many to search for multi-risk factor models. The most famous is probably Fama and French model that account for not one, but three risk factors. In addition to market risk, represented by beta, the model has two additional beta components, one related to the size of the company and another related to the book-to-market ratio of the company. Fama and French found empirical data showing that small stocks outperformed large stocks in the long run, and also that value stocks outperformed growth stocks in the long run. Many people contested his results, and they said that it was the result of data mining. Other people have taken it further by introducing other factors such as momentum. So you see a flourish of 4 or 5 factor models. The multi-risk factor models have also contributed to the growth of investing strategies called smart betas, which you've probably heard of, where investors, instead of just investing in a market, would add higher weights to specific risk factors such as company size, which would yield higher returns in the long run. A third hypothesis is to say that the market is inefficient. Therefore, assets are mispriced and arbitrage has failed to correct the differences. Solving the hypothesis puzzle is hard. When we find apparent mispriced assets in the market, such as these two here, we cannot tell for sure whether the market is inefficient because we don't know if our model is correct. This is called a joint hypothesis problem. This issue is an ongoing debate in finance and have split scholars into two schools of thought. A rational school of thought, which believes in market efficiency and creates models to understand this relationship between return and risk, and a behavioral school of thought, which says markets are inefficient because people make errors in setting prices and arbitrage trading fails to correct them. The market efficiency assumption is of key importance for understanding how to model the financial markets. We'll explore more about it next.